Every self-employed person pays self-employment tax. It is 15.3% of your net earnings, 12.4% for Social Security, and 2.9% for Medicare. On $80,000 of net self-employment income, that is $11,304 per year. What most freelancers do not know is that the IRS allows you to deduct exactly half of that amount, $5,652, directly from your gross income before your federal income tax is calculated. No receipts required. No special elections. It is a line item on Schedule 1, and it is available to every person who files a Schedule C. The legal basis is Internal Revenue Code, Section 164, 5-US. The logic behind it is straightforward. When you work for an employer, the employer pays half of your Social Security and Medicare taxes, 7.65%, and that cost is a deductible business expense for the company. As a self-employed person, you are both the employer and the employee. You pay the full 15.3% yourself. Congress created this deduction to approximate the tax treatment employees receive, acknowledging that you, as the employer portion, are paying a cost that a conventional business would deduct. The deduction appears on Schedule 1, line 15 of Form 1040. It is calculated on Schedule SE, which you are already required to file if your net self-employment income exceeds $400. Line 12 of Schedule SE shows your self-employment tax amount. Half of that figure exactly transfers to Schedule 1 as a deduction from gross income. It reduces your adjusted gross income. It does not appear anywhere on Schedule C. Many self-employed people who prepare their own returns miss this because they stop reviewing their return at Schedule C. The numbers on a $100,000 net income self-employment tax is calculated on 92.35% of your net earnings. $100,000 multiplied by 0.9235 equals $92,350. The SEtax rate of 15.3% applied to $92,350 equals $14,130. Half of $14,130 is $7,065. That is your deduction. Your federal taxable income is reduced by $7,065 before a single other deduction is applied. At a 24% federal bracket, this deduction alone reduces your federal income tax bill by $1,696 per year. It is automatic. It requires no documentation, and it exists for every self-employed filer. The 92.35% factor, officially described as 1 minus the SEtax rate, exists because the SEtax deduction itself would otherwise create a circular calculation. If you deducted the full SEtax from income before calculating SEtax, the base would shrink, the SEtax would shrink, the deduction would shrink, and so on. The 0.9235 multiplier pre-approximates that iteration. The IRS baked this adjustment into the Schedule SE calculation, so the form produces a consistent result without requiring iterative recalculation. You do not need to understand the algebra. Schedule SE does the work automatically. There is an additional Medicare tax of 0.9% on self-employment income exceeding $200,000 for single filers or $250,000 for married filing jointly. This additional Medicare tax, reported on Form 8959, does not follow the same deduction rules. You may not deduct half of the additional Medicare tax. Only the base 15.3% SEtax generates the 50% deduction. This distinction matters at higher income levels and is one of the reasons effective self-employment tax rates behave non-linearly above the $200,000 threshold. The SEtax deduction reduces your AGI, which cascades through to other calculations. A lower AGI increases your eligibility for the self-employed health insurance deduction. It can improve your qualification for IRI deductions if you also have traditional IRI contributions. It reduces the income base used to determine whether your Social Security benefits are taxable in retirement. And in the year you first become self-employed, understanding this deduction prevents the common error of computing estimated quarterly tax payments on your gross Schedule C income rather than your actual taxable income. If you earn self-employment income alongside W-2 wages from an employer, the SEtax calculation remains the same, but you must watch the Social Security wage base. For 2024, that base is $168,600. If your W-2 wages already exceed $168,600, no Social Security tax applies to your self-employment income, only the 2.9% Medicare component, plus the 0.9% additional Medicare tax above thresholds. In this scenario, your SEtax deduction is significantly smaller because most of the 15.3% rate disappears. Schedule SE accounts for this automatically when you enter both income types correctly. One strategic implication, the SEtax deduction is an above-the-line deduction. That means it reduces your AGI whether you take the standard deduction or itemize. If you are a freelancer who takes the standard deduction, as most do, this is one of the few deductions you get in addition to the standard amount. Treating it as optional or uncertain is a mistake. It is codified, automatic for anyone with Schedule SE liability, and the IRS expects to see it on your return. Missing it does not lower your risk, it simply increases what you pay. The SEtax deduction is not a loophole. It is a built-in feature of the self-employment tax system, available to every person who files Schedule SE. At $80,000 net income, it is worth over $1,300 in reduced federal tax. Over a decade of self-employment, that compounds to a meaningful figure. If you are estimating your quarterly tax payments and want to ensure you are not overpaying throughout the year, our video on quarterly estimated taxes, the exact formula, so you don't get penalized, covers the exact rules. This deduction lowers what you owe. Timing your payments correctly keeps the IRS from charging you extra on top of it. If this was useful, quarterly estimated taxes, the exact formula. The exact formula, so you don't get penalized, goes further. It is on this channel.